Hey everyone, welcome back to the Finance for Riches YouTube channel. In this passive income series, we move on to what I probably think is, in my personal experience, the most effective form of passive income, in the sense that there's probably some more stability to it than the other ones, but in terms of what your return is, it's probably on balance, something that I personally prefer. But the risk in it comes in the way of the actual cost and how much money is required. That form of passive income is rental income. So you can get rental income through many different aspects, whether it be leasing of a residential property, a commercial property, or some other kind of asset. But for the purposes of this particular series, we're just going to focus on rental income from residential properties. And there's a lot to it. And because of that and all the complexity which is associated with having a rental property or even buying one, we're going to split this particular video into two separate segments. So this is the first one. So rental income, the way it's generated from rental property is obviously you would go and acquire a residential house, and then you'd let that out to a tenant for a period of time. You generally have the option of managing through a real estate agency or doing it by yourself. Obviously, if you have a real estate agency, you got to pay them money for their services, so that's the commission that they'll take, as well as other costs, such as letting costs, sometimes advertising fees as well. But I guess you generally have some sort of sense of peace in the, if something goes wrong with your tenants, for whatever reason, there's a third party involved which can help you, I guess, mediate those issues. So, in terms of setup, so how do you go about this? So you have to go and acquire a house. So I guess you need effectively a spare house to rent out. Now, there's a whole bunch of different aspects you got to be looking at for when you're looking to rent a property. So when I say house, I use that term very loosely. You can obviously have a house, like a standard house on a block of land. You can have a unit, you can have a townhouse, you can have a duplex. A duplex is just a property where you can rent more than one party, because it's got two kitchens, multiple living areas, all the rest of that sort of stuff. So there's a whole bunch of different residential properties which you can look at first. Once you've narrowed that down, you know you want a house or you want an apartment or whatever, then there's a whole legal process in acquiring that property. Generally, you need a conveyancer, so you need a lawyer. You'll need finance. For that, you need a mortgage broker or a bank. And between those parties and yourself, you'll get the acquisition carried out and done. Now, you have a mortgage. So you'll conveyance it first. You will take a fee from you for the services. But then when you buy a property as well, you got to pay. In Australia, we have stamp duty tax. But in other countries, you may have another type of tax which is payable when a piece of real estate is sold or acquired, depending on, I guess, the wording of that particular legislation. And so you have those costs, but then and they can be substantial. But then the other cost which you got to take into account is the actual financing. So you would be generally required to have some sort of deposit to buy a property. We'll say houses to keep things simple. That's got to be a certain percentage of the overall cost of the property. The rest you can finance from a bank. That will cost you interest over the life of the loan. That loan can be 25 years, 30 years, whatever. So that interest is, as you guys will recall from the first video in the series, the cost of being able to use money. So you'll pay interest to the bank on top of the actual repayments you got to pay back on the loan you borrowed. So there's some outlay there, consistent, regular outlay. When you're looking to generate rental income, this passive income, the real benefit will come once that loan reduces. There's also tax advantages as well. I'm not going to touch this because, again, this is a very specific issue from country to country, jurisdiction to jurisdiction. But you've probably heard this concept of negative gearing. Negative gearing is when you have... And I'm going to have a video on this because negative gearing is one of those things that really gets on my nerves. People say, oh, negative gearing, why would you do that? Why do you want to generate losses on a property? Well, you're not actually generating losses. Negative gearing is very different to cash flow. You can have a positive cash flow property. What that means is property which is generating more cash in from its rental income compared to the amount of cash going out for paying interest, paying insurance, or paying commissions to the agent, all that sort of stuff. But that's very different to negative gearing for tax. Very different. Negative gearing for tax generally relies on things such as depreciation. Depreciation is not a cost, a physical cash flow cost to you. Well, it's an expense for accounting, but it's not a cash outflow. But that's a video for another day, and I'm 100% going to do it because, that's really annoys me when people say, why would you do it? Because they don't understand what it is. That's why. So you generate rental income, right? The other thing which you get from rental properties, and again, I'm not going to go into this in too much detail because this is a topic of its own, and we did touch on it when we did the video on dividends, is the capital growth, the increase in the value of the property. So that's not passive income, but that's a gain which you're building up, and then if you ever decide to sell the property, you can realize it and make a profit out of it. Another thing which you can do is you can use the equity of the property. Equity is the difference between what the market value is right now and what the loan owing on it is. So that difference there, that's your equity, and you can use that as a deposit to buy another property. So equity is very key in generation of wealth. It's probably, for me personally, I think that's one of the most powerful tools that you can use or have available. So that, while it's not passive income as item, it is something that's quite effective in building your wealth of your portfolio of assets. But like I said, there'll be a separate video on that. Now, the aspects on, I guess I've sort of touched on net returns, but we'll look into that in more detail, as well as the exit considerations on the rental property in a separate video. So watch out for part 2, guys. Like I say at the end of every video, please in the comments below have any topics listed there which you'd like to have financial literacy or financial commentary on. Like, comment, and subscribe. I'll see you guys for the next installment, which will be the video 2 on rental properties in this passive income series. Thanks, guys. Bye.